guys, my name is Ravi Sharma and I'm the founder and buyer's agent here at Search Property. Thank you so much for joining me on another episode of Search Property TV. If you haven't already and you like the content, then do smash the thumbs up button and give it a follow and subscribe with the bell icon, okay? Today's video, very important, 5 tips to pay down your mortgage faster. For most people in history, the highest cost that you will ever incur in your budget will be your living expenses. So when we're looking at an average $1 million loan, that at 3% interest rates is costing you $1,000 a week for the next 30 years, okay? Now that's granted that interest rates stay at 3%. Now obviously in some circumstances you're able to get lower interest rates at the moment, but as a guide, $1 million loan, $50,000 a year just to pay down the interest and principal of that mortgage. And this is why we become a slave to the mortgage or to the tax system, is because we're getting ourselves into a position to buy 6-bedroom houses where only 2 people are gonna live to impress people we don't actually like. The whole system is wrong. I do see it a lot in my social circles, and I can see how people fall into that trap. Now what's happening is we're looking at our parents and seeing that's what they were growing up with, and that's the mentality. They are now passing that through. So I see 25, 26, 30-year-olds getting into debt of $1 million or $2 million trying to buy their own home to live in. It's unproductive debt. So when I talk on this channel about getting into debt, I'm talking about productive debt, tax deductible debt, debt that's actually going to get you to acquire wealth rather than become a liability, which is what your home is. But we're going to kick straight into it. Here are my 5 tips to get into paying down your mortgage faster. But not only that, if you stay till the end, I'm going to show you my personal strategy of how I'm actually going to go and do what I'm doing on my 10-year investing journey, and then be able to buy my dream house debt-free. Okay, guys? Debt-free, living in your dream home, that's the ideal. Okay, so I'm going to show you how you can get rid of your mortgage at the moment, and then we'll kick into what my strategy is for that. So tip number 1, 100% offset account. Okay, so let me explain what that is. 100% offset account. Now, so many people are getting into the trap of trying to find the cheapest mortgage rate. It got advertised that you can get a 2% interest rate. I better go get that. What people don't understand is that these are very basic packages that a bank will offer you. Now, if you're in a position where you have a mortgage for your home that you live in, that's unproductive debt, it's not tax deductible. So the idea is that you want to pay down that loan as quick as possible. Reason for that is because that is a liability, okay? When you've got debt attached to an investment property, it's a debt, but technically it's fueling an asset and it's providing you an income. So technically it turns into an asset. But when we're looking at a 100% offset account, what do I mean by that? I'm going to show you a simple example of what that means when the next time you talk to a banker or broker and they're looking at options for you and features. We're looking at if your home, right? If your home is $1 million and you took out an 80% loan, LVR, loan to value ratio, okay? So you've taken out an $800,000 loan. Now you have to pay your repayments made on $800,000. However, you may be in a position where you've actually saved $100,000, or you have an account where all your salary goes into and you're saving that money. So in this case, what you would do is you'd have an offset account. So I don't know how to show you that. We're just going to call it that. And that is linked with the home. So over here, let's say that's our savings and we have 100K. 100K of savings in this bank account. Now, what you could do is if this is linked, if that is linked, the bank will say that, well, you know what, if today Ravi decided to pay down his mortgage of $800,000, he could use the 100K and he could pay down $100,000 worth of debt. So what we're gonna do is, as long as he has funds in this account, we will calculate interest daily. So instead of calculating interest 2% or 3% on $800,000, we're actually going to do it based on 800 minus $100,000, which means you're paying interest on a $700,000 loan, okay? So I hope that makes sense. It is a video, so you can just go back and watch it again. But loan for $800,000, because you have $100,000 in an offset account linked with this mortgage, you're able to go and pay interest on $700K instead of $800K. And that ultimately means that your repayments will stay the same. So let's say your repayments are $3,000 a month. They're gonna still stay $3,000 a month, but it's gonna pay down more of your principal because now your interest getting charged is a lot less. It's not on 800,000, it's on 700,000. This is a big hack that you can at least eliminate part of that principal quicker as long as you have funds in this account. Now, I don't want to go into too much depth of how to effectively use an offset account, because you can basically come up with a strategy where you can just milk the benefits of something like this with credit cards. If you're interested in that sort of video, then either DM me on Instagram, search property AU, or just leave a comment down below. If that's something you want to get, you're interested in and want to learn my strategy for how I would do it, then definitely leave a comment down below. But that's pretty much what a 100% offset account is. So next time we're looking at, loans, or you're looking at your loan documents and they're going for just a base package variable rate, that will often not include an offset account. And what you could save in that time will be a lot more than just the 1 or 2% difference that you're trying to save, or basis points you're trying to save on a different mortgage rate, okay? Tip number 2 is pay fortnightly or weekly repayments. So pay weekly or fortnightly repayments. Now, most loans are structured so that they're getting paid monthly. So when you get your mortgage documents, they're going to say, well, this is going to be your monthly repayment for that mortgage. However, if you're getting paid weekly or you're getting paid fortnightly, well, then you could pay it even quicker, right? So if you are able to pay it quicker, interest is charged daily, your loan balance will keep falling more consistently, which means the interest that you have to pay on that fund, or that balance, is actually going down more frequently than if you were to make 12 monthly payments, right? So for example, if you were to just simply go from paying monthly to fortnightly, that would mean 26 payments versus 12 payments, which means interest that's getting calculated is on a lower balance than if you were paying 12 monthly payments. And this could significantly reduce how long your loan lasts for. In some cases I've seen it could reduce it by 6 years. So as a combination of the 5 tips I'm going to tell you, you could significantly reduce your mortgages and have to pay them in less than 10 years, rather than having to go, well, you know what, I'm going to fork out $1,000 a week for the next 30 years, which, if you start working at 25, 30, until you're about 55, 60, you haven't paid off your loan, and you're still paying that $50,000 a year. So my next tip is pay weekly or fortnightly repayments. Ideally, when you're getting that salary come in, you can just go straight into paying down your loan even quicker. Tip number 3 is refinance your mortgage. So refinancing your mortgage at the moment is to record interest rates. Now again, when we're looking at interest rates, it's not the end solution, but it does play a part, because obviously that's the cost of borrowing. So if you can get a product where it's actually reduced how much interest you're having to repay, well, that's going to be a win and more money in your pocket, right? So refinancing, some people don't really understand how it works. They get confused, or they get very scared of having to reapply and do an application, and that's where a broker really can help you. So if you need some help, contact us, we'll point you in the right direction. But refinancing is pretty much having to reapply for a loan with, say, a different bank, and you're getting a lower interest rate. So at the moment, if you're looking at refinancing, a lot of banks are offering cashbacks, right? So quite often you're having to pay legal fees or discharge mortgage fees. That can be covered with the cashback you're going to get. Now, if you can save, say, 2% on a mortgage rate, and your debt is $1 million and you were at 4% previously, well, that's $20,000 that you're going to save just by moving the loans across. Now, what's the difference? Well, you got to reroute, your rent or your salary goes into a different account. And 2, the logos change on your net bank, right? So it's a very simple solution to really trying to save money quicker. And the real hack here is that if you can still remain paying your monthly or fortnightly repayments at that higher interest rate and you bring it across to here, you're paying extra. So if you've budgeted for $2,500 a month and now you only have to pay $2,200 a month, we'll continue paying $2,500 a month. And that extra $100 or $200 a week or a month is actually going to reduce your home loan repayment terms by years. And I'm talking years. And it all depends on how frequently you're paying. And as a combination, again, we could reduce it quite quickly. Tip number 4, and this is somewhere where we're getting a bit more complex, and this is where we're really getting into people's mindset of breaking out the shackles of thinking debt is bad. Productive debt is good. So if you're looking at paying down your mortgage even quicker, that unproductive debt, attach yourself with assets that are with productive debt and providing you a cash flow. So my 4th tip is to purchase positive cash flow properties. Now, the way I like to think of it, and it's a very simple way of trying to understand it from a different sort of point of view, is let's say for instance, at the moment it's you and your partner or yourself that's working and you're paying down your repayments for the home loan, right? So it's just one income that goes in, right? So if this is the home, my home's a real shonky, and you have one income stream paying down that home loan. Now, the way I look at positive cash flow properties is depending again on what stage you're in of your strategy and what your goals are. But if you find yourself in a position where you feel like you're shackled in and you're a slave to the debt system of unproductive debt with this mortgage, well then, why wouldn't you attach, say, 2 cash flow producing properties, right? Now, this is your income, so salary, and these are P1 and P2. Now, here, you may actually be paying, say, $2,000 a month towards the home, and that's coming out of your pocket. But if you have now attached yourself with, say, 2 positive cash flow properties that actually give you money in the pocket by, say, $200 or $300 a week, well then that's an extra $200 or $300 you're pumping straight back into paying down your mortgage. Now, a couple of things that can happen here. Now, let's say for instance, you are in a really high stressed out job, very stressful, long hours, and you really want to tone it back. You want to spend more time with the family and the kids, right? At the moment, you can't afford to because your salary is, say in this case, $2,000 and that's the repayment. So that's all you have left over after spending for your child care or whatever else you need to spend, and that's what you're left with. Now, if you have a property that gives you, say, $200 there and say $200 there, well, suddenly this and this is pumping straight back in, which means you can either continue working that high stressed out job to pay down your mortgage, or you can attach yourself with these positive cash flow properties that start hitting away. So in this case, you might actually be getting back 2 days of the week. Does that mean you work part-time and spend more time with the kids? Does that mean you want to use the advantage of positive cash flow and rising rents to then go, well, I've got so much income coming in, I can actually pay down this loan in 9, 10, 11 years instead of having to wait 30 years to pay down the loan? That's a decision for you. Everyone's financial situation is different. And a quick note that I'm not a financial advisor. This is all general in nature, and if you do want some sort of tailored advice, do contact us below. We've got some connections, we can help you out, right? But in this case, this is only 2 properties. If you were to go and purchase 4 or 5 of these, you could effectively stop working, use the money that comes in from your investments and pay down your loan, right? So that's tip number 4. Tip number 5 is probably the most simplest tip I could give you, which is make extra repayments. Now, as I said with the example of refinancing to a lower rate, you may actually still be paying or could afford to pay the higher rate, what you were paying before, the repayments you were making before, but now you've got a repayment that's lower than that, right? So just make the extra repayments. So extra repayments, right? So if that means you were paying $2,000 before and you now are having to pay $1,500, well, don't change the budget. Keep it to $1,500, 1,500 plus the 500 from before. So you're paying $2,000 before, you're paying $2,000 now. However, we're hitting more of that principal. And as you keep knocking down the principal, the interest on the principal is lower as well. So every month you are compounding and compounding the effect, and effectively, as a combination of all of these things used together, I could say quite confidently, you could get a 30-year loan, 30 years, paid down in less than 10 years. We had a client that contacted us and was like, look, this is where we're at in the stage. I've got 2 young kids. I've got a mortgage of $800,000. I've got, I want to buy investment properties, but I want to buy them in growth areas. We've now restructured all that. He's now gone to working part-time. He's got 2 investment properties that we've helped him purchase. He's using that income to now pay down the loan, and he's got a better lifestyle. He's in his dream home now, and he's spending more time with the kids. And why? Because he changed out of that mindset that people are so fixated on, that I want growth properties, I want capital growth. If you guys want to understand the difference between cash flow and capital growth and how it could help you, there's a video I've put on this channel. You'll probably see a card up here at some point, cash flow versus capital growth. This is very interesting, very something that you need to really understand, especially when it comes down to your stage of the strategy. Now, I told you at the beginning of this video, I told you that I'm gonna tell you exactly what I'm doing, right? So we're gonna get rid of these, and I'm gonna tell you my entire sort of strategy around me buying my dream house debt-free. So this is the dream house, right? This is Ravi's dream house, okay? So Ravi, dream house. Now, yes, I would like to eventually just settle down in Sydney and, I want to have certain things in that house. So how do I do it? Now, a house that I'm looking at could cost millions, right? Now, could I afford to pay millions right now and get, become a slave to the system? I could, but I don't want to. There are alternatives, and this channel is all about educating you about alternatives, right? So if Ravi could afford to buy this now, why wouldn't he buy it? Because I would have to still get a loan to pay this. Rather, I would try and invest in multiple properties, right? These are my investment properties, and I want to go and do a couple of things here. Now, this is what I call is a dual property portfolio, right? This is where you could have, say, this and this is cash flow, and this is capital growth, okay? Each property serves a purpose, okay? Go back to that video that I've shot, capital growth versus cash flow, and you're gonna understand what a dual property portfolio is. But essentially, what I could do is go, okay, these capital growth properties in 10 years' time, right, will have grown a certain amount. That money I would use to then either pay down these homes, use the income from here and pay down my loan here in 10 years' time. So I'm not affecting my lifestyle, because that for me is important. I want to mitigate risk. I don't want to be at the point where if I lose my job tomorrow, fortunately for me, I work for myself, right? But if I don't want to be in a position where I lose my job, I lose my house. That is the situation most people are in today, right? I don't want to be in that. So instead, there's an alternative. Instead of buying your house first, you go in and buy your investment properties elsewhere. You've got positive cash flow and you've got capital growth. Then I'm going to use these properties and either sell, pay these debt down, then this income is going to go in and pay down the home loan, or I could use this income and pay down my home loan and live absolutely free. Guys, this is a very complex sort of strategy, and obviously developed over years. If you are interested in creating something similar for yourself, and you would rather go, I want to have a bit of delayed gratification and understand I can still have my lifestyle. It's like going, I can have my cake and eat it too. This is the combination that I'm educating people around. And once they understand what they understand now, they look back and they see the old way of doing investing in property and buying your home first and being shackled to the system is actually the wrong way. People often say that people who rent are poor. They've got a poor mindset. I'm saying that the poorest thing you could do is get liability, right, that shackles you in for the next 30 years by buying your principal place of residence, a 6-bedroom house, to impress people you don't like. And that's where the fundamental flaw is in that mindset. And I think that's more poor than if you were to go out and rent in a place you really love, but grow your asset pool in the back. Guys, thank you so much for sticking out the entire video with me. If this is important to you, subscribe down below. If this is a video where I've shared the ideas that make sense for you or your family or your partner and you want them to understand, share this video, okay guys? Thank you so much again for joining me on another episode of Search Property TV. I'll catch you guys in the next video.